Since the 1950s, the S&P 500 has returned investors an average of approximately 10% per year. But here's the thing, in order to continue delivering this sort of returns for the next 50 years, the S&P 500 needs to be 125 times higher than where it is today. At the same time, there is the argument that if the S&P 500 does indeed keep a 10% growth rate for the next 50 years, and the economy keeps growing at 2 to 3% per year as well, the stock market will be so much greater than the economy that this might not even be possible. So how likely is it that it will continue rising as it has done in the past? And what are the chances that passive investors today will actually earn an average of 10% per year by investing in the S&P 500? Let's have a look. Opinions about the future performance of the S&P 500 vary. The optimists cite factors such as technological advancements, innovation, and the resilience of the US economy as reasons why the S&P 500 will continue to perform well over the long term. They argue that despite fluctuations, the market tends to trend upward over extended periods. Conversely, skeptics emphasize the importance of considering economic shifts, geopolitical changes, and market dynamics that could impact future returns. They caution against assuming consistent high returns based on historical performance. So let's unpick both these views. The success of the S&P 500 over the long term is closely linked to the success of the United States economy. And the reason why this group of companies has returned an average of 10% per year since the 1950s is a result of the robust growth experienced by the United States economy during that period. What does that mean? Well, when the economy is doing well, it means that people are making more, they are spending more, productivity levels rise, and all in all, businesses see their profits increase. Increasing profits makes companies more valuable and thus stock prices rise, which, you've guessed it, means that the S&P 500 rises too. So there is no question that the state of the economy has an impact on the performance of the stock market. In other words, over a long period of time, a thriving economy is what's fundamentally needed to power businesses and the stock market forward. But here is where things get interesting. If we take the population growth of the US as an example, since the 1950s, the US population has increased from about 150 million to 340 million, a total gain of over 120%. This obviously had a massive impact on productivity levels and the state of the economy. Think about it, the fact that the population more than doubled means that more stuff was made and sold and overall more revenue was generated. However, here is what the UN is projecting over the next 50 years. They think that the US population will go from 340 million to just close to 390 million. This is only a 14.7% increase. In fact, the population of the US grew just 0.4% in 2022, which is better than 2021 but worse than every other year in the past 100 years. So there is no doubt that the American population growth is slowing down. While this doesn't necessarily mean that the S&P 500 is going to be slow over the next 50 years, the fact is that population growth made a substantial impact on the growth of the economy and the S&P 500 in the last 50 years. However, things have changed massively since the turn of the century, and we all know that the buzzword at the moment is artificial intelligence. But just before we look at this next section, do me a huge favor and hit the subscribe button if you haven't already. It really does help small YouTube creators like me. Thank you. Some people may argue that even though population growth is declining, if we give people tools that help them double their work, then it's highly likely that productivity doubles too. And what facilitates that increase in efficiency without the need for more manpower? You've guessed it, artificial intelligence. Many people argue that the rise in AI will more than compensate for the shrinking population growth. Take ChatGPT for example. It's already been replacing jobs across many industries, with 99% of the companies using ChatGPT reporting significant cost savings. A survey which polled 1,000 US business leaders found that 48% of participants said their companies have replaced workers with ChatGPT. This shouldn't really come as a surprise because we've already seen the power of ChatGPT in our own daily lives. We all use it now for various purposes. And let's not forget that this tool is only scratching the surface of what AI can do. Lots of people believe that there are in fact two specific fields that will increase human efficiency and productivity: artificial intelligence and robotics. Have a listen at what Elon Musk says here.
Given that economic output is number of people times productivity, if you no longer have a constraint on people, effectively you've got a humanoid robot that can do as much as you'd like, your economy is quasi infinite.
So Elon believes that despite a decrease in population growth, the advanced tools available to boost our productivity will make a significant difference. He thinks that our ability to accomplish work will be so enhanced that it will lead to a remarkable increase in economic output. AI is rapidly being adapted for use across multiple industries, from copywriting, construction or agriculture to driving, travel, banking and so on. And what this enables is a massive increase in efficiency and cost savings. Overall, it's proving very beneficial. Therefore, despite the fact that the American economy is losing one important contributor over the next 50 years, which is population growth, if the other element that impacts economic output is much stronger, then economic growth could outpace the levels seen in the last 50 years. As a result, profitability across the board should increase, which in turn will drive stock prices up, and thus the entire S&P 500 will go up too. Does that mean that it will continue delivering the average return of 10% per year that we saw in the last 50 years? Well, it's hard to tell, of course. On one hand, you could argue that the population decline could have significant consequences on the United States economy, which will massively impact the stock market. But you could also argue that the technological advancements in the AI and robotics space could lead to a growing economy and stock market. This being said, there is a third aspect which implies that even if productivity increases, if the population declines, then there will be fewer people to buy the things that are being produced. So it's kind of a catch-22 situation. But yeah, the truth is that it's a very complex subject and no one knows with certainty how things will pan out. I would love to hear your opinion on this whole topic. Do you think the S&P 500 will be able to increase 100 times in the next 50 years? And if so, what would be the driver of that growth? Let me know in the comments. However, there is a small detail that I think is worth mentioning, and that is to do with investment timing. Every time you hear someone talking about the historical returns of the stock market, they will often mention the 10% returns we saw since the S&P 500 was created in 1957. But this average return of 10% per year is significantly different if we change the time period by only a few years. For example, from 1961 to 2020, the stock market paints a completely different picture. The average annual return of the S&P 500 is no longer 10%. In fact, it drops all the way down to 6.2%. So something to keep in mind is that investment returns can change depending on the entry and exit points. The last point I want to mention, which has to do with the argument that if the stock market continues to grow at 10% in the future, it will significantly outpace the economy, is nicely explained by this Reddit user. The assertion that the market can't keep growing at the same age in the long run is simply empirically wrong. Of course, in the short run, less than 10 years, it could be different. But if the current structure of our global capitalist economy remains mostly the same, equity returns of this magnitude will be there in the end after all. Why? Because equities are a claim on the earnings and dividends of companies in the real economy, and also have an additional risk premium associated with them because of the inconvenient times, recessions, wars, etc. that they experience drawdowns. Furthermore, equities can continue to grow faster than the economy into perpetuity with no economic problems associated with that. Equity returns come from real earnings growth, dividends and valuation change, and equity investors don't simply buy and hold into perpetuity. Individuals fund their retirements, institutional investors spend annually to support their missions and so on. And because of stock splits, mergers and acquisitions and other activities, as well as dividends, the returns to equities that an investor actually experiences can be much higher than GDP into perpetuity. And indeed, we would expect this. This being said, the bottom line is that no one knows how things are going to pan out in the next 50 years. And I think that the best strategy is to be in it for the very long term, by simply investing in an index fund that tracks the entire market, or even more than one if that's your investment strategy. In fact, check out this video next to find out how many funds you should actually hold in your portfolio.